We are covering these 7 top stocks with big percentage gains today. While watching bullish price actions, let us inform you. Our review on DATS. DatChat Incorporated is all about privacy in the digital age, blending messaging, metaverse, and social media to give users control over their information. Their flagship product, DatChat Messenger and Private Social Network, lets people send messages with self-destruct timers, block screenshots, and even hide encrypted photos in plain sight. It's designed to give users full control, whether it's deleting messages after they're sent or making conversations disappear entirely. Essentially, it's privacy-focused social networking in a world where data security is more important than ever. And today, DatChat stock is absolutely on fire, up 75%. The big news? They just rolled out their Mycelium social media platform on iOS and Android. Mycelium is designed to securely store and share digital memories, photos, videos, and documents, while using AI to help families and groups create private digital legacies. This isn't just another photo storage app. It's a next-gen social media play focused on security and permanence, something that sets it apart from the usual platforms. The company is clearly pushing hard to get Mycelium in front of the right audience, too. They just announced they're sponsoring the Photo Managers Conference 2025 in San Diego next month. A smart move, since that event brings together people who are serious about preserving and organizing digital memories. Between the launch and the new marketing push, DatChat is making a strong case that they're more than just a privacy-first messaging app. They're building an entire ecosystem. The 75% surge in the stock price shows that investors are paying attention. A major platform launch, AI-driven technology, and a rapidly expanding market reach? That's a recipe for excitement. Now, the big question is whether they can keep up the momentum and turn Mycelium into a major player in the digital storage and social media space. Our review on POAI. Predictive Oncology Inc. is making waves in the biotech world, using AI and machine learning to revolutionize early-stage cancer drug discovery. Their proprietary PEDAL platform is designed to predict, with a remarkable 92% accuracy, how tumor samples will respond to different drug compounds. That's a game changer. By tapping into a massive biobank of over 150,000 tumor samples, they're essentially giving pharmaceutical companies a major head start, cutting down the time and cost of drug development while increasing the odds of success. Instead of the traditional trial-and-error approach, they're using data-driven insights to fast-track promising treatments. And today, the market is taking notice. Shares of Predictive Oncology are surging after they announced a major breakthrough in their collaboration with the University of Michigan's Natural Products Discovery Core, NPDC. The company has developed predictive models using 21 novel compounds, and the early results are more than promising. 3 of these compounds showed powerful anti-tumor effects across multiple cancer types, outperforming doxorubicin, a standard chemotherapy drug. That's huge. Another compound was particularly effective against both ovarian and colon cancer, while 3 others demonstrated strong responses for breast, colon, and ovarian cancers. This isn't just another biotech announcement, it's a real demonstration of how AI can be used to speed up drug discovery in a meaningful way. And the most exciting part? These results are based on just 1% of the compounds available in the NPDC library. That means there's a massive amount of untapped potential here. If Predictive Oncology continues to deliver breakthroughs like this, they could become an indispensable player in the world of oncology drug development. For investors, this is an important moment. The stock's big move today suggests the market is recognizing the value of Predictive Oncology's approach. They're proving that AI and machine learning aren't just buzzwords. They're tools that can dramatically improve how we discover and develop new cancer treatments. If they can keep building on this momentum, the long-term upside could be significant. It's definitely a company to watch as they continue pushing the boundaries of AI-driven drug discovery. Our review on RAY, Raytech Holding Ltd, the company behind sourcing and wholesaling personal care electrical appliances, is making serious waves today, up a massive 49%. A move like this doesn't happen out of nowhere. So let's dig into what could be driving the surge and why investors are suddenly piling in. First off, Raytech isn't just in the business of selling personal care appliances. They also collaborate with customers on product design and development. That gives them a competitive edge because they're not just moving existing products. They're shaping what consumers actually want. In an industry where innovation is key, having that level of input and control over the final product can mean higher demand and better margins. Now, while we don't have the exact reason for today's explosive stock movement just yet, a 49% jump usually means something big is happening behind the scenes. It could be a major deal, a new product launch, a stronger than expected earnings report, or even positive sentiment surrounding the broader personal care market. Sometimes a big spike like this can also be the result of a short squeeze, where traders betting against the stock are forced to buy back in, sending shares even higher. Whatever the case may be, this kind of move tends to get investors' attention, and with that comes more trading activity and speculation. If Raytech can build on this momentum and back it up with solid business fundamentals, we could be looking at a company on the verge of a breakout. But as with any stock that jumps this quickly, volatility is something to keep in mind. So, is this just a one-day pop, or is Raytech setting itself up for something bigger? That's the question investors will be asking. But one thing's for sure, today's 49% surge has put this company firmly on the radar. Our review on SAG Holdings Limited, the Singapore-based player in the auto and industrial parts business, just shot up 31% today. And you have to wonder, what's driving the surge? This company isn't just your average parts distributor. They've got a solid presence in both the on-highway sector, supplying OEM and aftermarket parts for cars and commercial vehicles, and the off-highway sector, catering to heavy industries like marine, energy, and construction through their Philtech brand. With a big chunk of their global sales coming from the Middle East and Asia, SAG Holdings is positioned in markets where demand for both vehicle and industrial engine components remains strong. So, when you see a stock move this much in one day, it usually means something significant is happening. Maybe strong earnings, a major contract win, or even a market shift in their favor. Another angle to consider is the supply chain. With global disruptions starting to ease, companies like SAG Holdings, which thrive on distribution, might be benefiting from improved logistics and better inventory flow. Or maybe they've landed a key partnership that expands their footprint even further. Regardless of the exact reason, a 31% jump signals that investors are taking notice in a big way. Now, the real question is, does this rally have legs, or is it just a short-term spike? If SAG continues to deliver strong growth and capitalize on its markets, this could be the start of something much bigger. Our review on AAME, Atlantic American Corporation, an insurance holding company that operates through its life and health, as well as property and casualty segments, just dropped some numbers that got investors paying attention. The company posted a Q4 earnings per share of 2 cents. Yeah, that might not sound huge, but when you compare it to last year's loss of 11 cents per share, that's a serious turnaround. On top of that, revenue climbed nearly 5% year over year to $49.04 million, showing some solid top-line growth. And here's the kicker. They also declared a 2 cents dividend. That's always a sign of confidence, suggesting management sees financial stability and wants to return value to shareholders. Given that the company has been working to improve profitability, this earnings report signals that their efforts are paying off. The insurance game can be a slow and steady kind of business, but when a company shifts from losses to profitability, even on a small scale, investors take notice. It's worth watching to see if Atlantic American can keep this momentum going or if this quarter was just a one-time boost. Either way, a positive earnings swing and a dividend announcement, that's a double win for investors. Our review on PSTV plus Therapeutics Incorporated is making waves today, with its stock climbing 25% as investors look ahead to the company's upcoming earnings report. But let's be clear, this isn't your typical earnings-driven stock. Like many clinical stage biotech firms, Plus Therapeutics isn't turning a profit yet, and analysts are expecting a 50 cents per share loss. But in this space, the real story isn't about short-term financials. It's all about the science and the potential for game-changing breakthroughs in cancer treatment. So, what's got investors excited? Plus Therapeutics is focused on developing targeted radiotherapeutics for central nervous system, CNS cancers, an area of medicine where new treatment options are desperately needed. Their lead candidate, rhenium-186Re, obisbemeda, is designed to deliver high-dose radiation directly into tumors like recurrent glioblastoma, GBM, and leptomeningeal metastases, LM. These are some of the most aggressive and hard-to-treat cancers, and current treatments are often ineffective. If Plus can prove that its approach works, it could carve out a highly valuable niche in oncology. Beyond rhenium-186Re, obisbemeda, Plus is also working on rhenium-188 nanoliposome biodegradable alginate microsphere, 188 RNLBM, a mouthful of a name, but an exciting potential therapy aimed at treating a range of solid organ cancers. The company is banking on its ability to combine precision-targeted drug delivery with the powerful tumor-fighting effects of radiotherapy. It's an approach that, if successful, could revolutionize cancer care. Now, why the stock move today? The most likely reason is that investors are positioning ahead of the earnings call, anticipating updates on clinical progress or upcoming trial data. In the biotech world, stocks don't just move on earnings. They move on pipeline progress, regulatory updates, and potential partnerships. A positive development, whether it's strong early data, an accelerated regulatory pathway, or even whispers of a big pharma collaboration, could send shares soaring even further. On the flip side, delays or underwhelming results could bring the stock back down just as quickly. Plus Therapeutics has been making steady progress with its pipeline, and the upcoming earnings call could provide key insights into where things stand. For now, it's a high-risk, high-reward play, typical of the biotech sector. Investors who believe in the company's science and long-term vision are seeing today's move as a sign of growing confidence. But as always in biotech, the next big catalyst will be clinical data, because at the end of the day, results are what really matter. If Plus can deliver strong efficacy and safety data, this could just be the beginning of a much bigger move. Our review on HIT. Health in Tech Incorporated just made a pretty exciting move by partnering with DialCare, a well-known provider of telehealth and virtual care solutions. For those who aren't familiar, Health in Tech operates as a tech-driven insurance platform, offering customizable self-funded health plans for businesses and organizations. This new collaboration is a significant step forward for the company, as it will integrate DialCare services, including virtual primary care, therapy, and psychiatry, into its offerings. Essentially, this means that members will have on-demand access to licensed healthcare providers via phone or video consultations, adding a huge level of convenience and flexibility to their healthcare options. For investors, this is a major development. Telehealth has been growing at an incredible pace, and by adding these services to its platform, Health in Tech is positioning itself at the forefront of a fast-evolving market. It's not just about offering traditional health insurance anymore. It's about offering innovative solutions that meet the needs of modern healthcare consumers who want more accessible, flexible options. The integration of DialCare services will likely attract new clients, enhance customer satisfaction, and improve overall retention, which could translate into stronger revenue growth in the long run. The market seems to have recognized the potential here too, as evidenced by the uptick in stock performance today. This partnership with DialCare could be just the catalyst health in tech needs to expand its market share and solidify its place in the growing insurtech and telehealth space. If you're watching this company, it might be time to keep a closer eye on how this development unfolds. It could be setting up some exciting growth ahead. Please subscribe, give the video a like, and watch more from our playlist. Thanks.